I'm Matt Greenberg. I'm the chair of the corporate group at Troutman Pepper, where I focus my practice in private equity. Today, I'm joined by Jeremy Levy, who also practices with me in the private equity practice at Troutman. And today, we're here to discuss different perspectives and the outlook for 2023.
Funds are out there trying to do deals. They just seem to be sourcing them a lot more in-house. They're doing the work. They're sort of pounding the pavement, so to speak, and having a lot of bilateral discussions. And it feels like what that's going to lead to is, fewer auctions for most of the year. Maybe as uncertainty wanes a little bit with the interest rates rising, or the interest rates, the rise of interest rates slowing down and the Fed moving in a more predictable way. It feels like that uncertainty will release from the marketplace, and you'll have more companies coming to market maybe the second half of the year. But at least for now, it's a lot of bilateral discussions. It's a lot of club deals. It's a lot of minority investments, a lot of co-investments. Some of that is picking up on trends that were already in motion during 2021 and 2022, just the sort of shift in the market towards more and more co-invest funds and things. But some of that is just dealing with the uncertainty. How can a fund deploy capital with a sort of in a de-risked kind of a manner? So it's interesting. It's going to be an interesting year, especially with the next Fed meeting. If it's another quarter of a point, or they stop raising the rates, right? I think that certainty will come back into the marketplace and should be a relief.
Exactly. I also think that because you're going to have less of a frenetic pace, people are going to be looking at deals really closely to think about how they fit into their overall strategy and portfolio, and making sure that the asset is a really good asset that they're going to pick up. Mm-hmm. And I think they're doing that partially for themselves. And the other time you see it because they're dealing with the rep and warranty insurer, which are in pretty much every one of our deals, mm-hmm. as well as the debt providers, to making sure that they're on board with the due diligence and the leverage that's going to get put on the company. What are you seeing in terms of the third parties that have to get involved in the transaction?
Yeah, so it's a relief for people like me and people like you and people on our team to no longer have as many 7-day exclusivity periods where you have to get the whole deal done in a week. It feels like those days are behind us for at least a little while. And so deals are taking longer. Pace has changed significantly. As mentioned before, structure has changed significantly, but pace has really changed. I think especially, you mentioned lenders. I mean, there was a time not so long ago when lenders kind of looked at the diligence report for a deal, and they looked at the financial report and they're like, okay, that sounds fine. In recent deals that I've been doing, we've got the rep and warranty insurer who always goes through their diligence process and their underwriting process. But the lenders are asking more diligence questions than the insurers. And it seems to be sort of across the market, across all institutional lenders. They're just doing more work. They're taking more time. It seems like there's more bargaining power in the hands of the lenders. And that's slowing deals down for funds. But that creates an interesting dynamic as well for strategics, right? You were just recently speaking with some of them.
Yeah, I was just in a meeting with business development folks from a number of strategic companies, and they said they're excited because people who have strong balance sheets are excited to basically just show up and say, I have the cash, I have the deal certainty, and while I have maybe more internal approvals, I'm going to be there with the money at the end of the day. So I think they're going to look at that as something that gives them an advantage, maybe back into the marketplace, that I think private equity buyers are going to need to keep that in the back of their mind. The good news, though, is the money is still out there for borrowing, whether it comes from a bank or a non-bank source. That we still do see a lot of term sheets coming across for people who want to lend. It's just not, again, it's sort of the same pace, which is why I think overall we'll still be looking at a strong deal market.
Yeah, I mean, historically, it seems like, at least in the past 5 years or so, like, private equity can usually move faster than strategic, even if they need to go get debt. They're just professional buyers. Strategics take their time. This dynamic with lenders being more deliberate about the process, causing private equity funds to have to move more slowly, it's bringing that sort of time frame for the strategic and the private equity fund to be more similar. And so that sort of differentiator that funds had in recent years, they still get deals done. They still are, they're still professional buyers of companies, but they don't move all that much faster as strategics do in this day and age, at least for platforms where you need,
Exactly. I think for platforms, that's certainly the case. I think for the add-on acquisitions, where a lot of our clients were lucky enough to get a good platform out there, I think you're still going to see a lot of buyers in the platform add-on space for the next couple of years as well, because there's a lot of companies sort of in the lower middle market that fit in well with a platform play.